Hello, Amit. Can you hear me?
I can hear you loud and clear. Can you hear me?
Okay. Thank you so much for being on here to the Startup Expo 2022, organized by TechGenez. I'm going to give a brief intro about Amit Grover. He's a very passionate man about startup because he is a founder and managing partner at Grover and Company and Grover Impact Ventures, an ESG focused fund manager building an impact fund in the United Arab Emirates, popularly known as Dubai. He actually comes with over 24 years of professional and entrepreneurial experience in marketing, management, consulting, and venture capital. He has worked in MNCs such as ITC Limited, Barrister Coffee Company, and Pernod Ricard. He is also distinguished with a full-time MBA degree from Victoria University of Wellington in New Zealand. He took a plunge into the world of entrepreneurship in 2008, founding Grover and Company, a boutique management consulting practice which advises SMEs on international business with focus on ESG, integration, and IP monetization. He's from humble beginnings in New Zealand to Grover and Company's expansion into Australia, United Arab Emirates, and the United Kingdom. In fact, if I keep talking about him, I don't think you're really going to live here. So I'm going to allow him to speak to us on what he's got for us today. Thank you so much, Amit, for being on here again.
Thank you so much, Sandra, for introducing me. And would love to speak to startups. Today, my topic is all about startup funding. Great. So, look, today's topic is a much sought after topic and much discussed topic among startups and young friends who want to found companies. That how do you get funded and how do you raise capital to be able to do that? So I'm going to take you through a journey that would, first tell you why we need to kind of raise capital and how that helps our venture. Then followed by the different types of capital raising sources that one could exploit in their different life cycle and stages of business, and then kind of dwell a little deep into understanding your business life cycle and the kind of funding you need and why you need that. And lastly, just to touch upon who I am and what I do and how I could potentially help startups across the world. So let's kind of take a deep dive. So why do we need startup funding? I think the first aspect of why do you really need funding is when you have a venture, either you're working with a product or a service or a solution. So to develop a minimum viable product or a service that is feasible to be launched in the market, you need a bit of capital. I think the second stage from there on is much about market validation. Now, the product or the service that you're developing for your customers, how feasible is that? Does it have a increasing need in the market? Are customers happy with what you have to offer them? And that kind of validation that basically tells you that, yes, my product or my service can go places. The third aspect where you really need a bit of funding is to launch your product. I mean, when you launch a product or a service, there's so many factors that you've got to keep in mind. You've got to do market research. You've got to input that research back into your product development. You've got to do marketing, public relation, sales strategy. So I think you need a lot of money when you launch a product or a service in your local market. Then obviously you're trying to expand your product, expand your venture, expand your business, and you can only do that by acquiring customers. So obviously there's a huge amount of spend that you have to do in customer acquisition programs. Then the question comes to grow. I mean, you can grow in your state or in your region, but then most ventures are ambitious enough to go countrywide or nationally. And I think when you're trying to scale up a venture beyond your local area or your comfort zone, I think supported with the right kind of capital, gives the right outcomes for your venture growth. After which, when you become a mature venture and you're doing quite well, I think one of the inherent things ventures and companies like to do is grab market share. beat their competition, grab market share, and become pretty much a household name or a business name based on what segment you're marketing your product and service to. And that's when your scale up capital is needed and some serious level of capital is needed. And then the last aspect of your growth is exponential growth, where your ambitions are outside your country. You want to go big, you want to acquire companies, and incorporate that in your portfolio and offer your product and service to a much larger target audience, maybe even international markets where you need exponential growth and capital for. So each of these stages requires certain amount of capital, and that capital will help you advance from one stage to the next stage based on how successfully you execute that stage. Now, let's talk about some of the sources of funding that is available to us in terms of when we want to raise capital for our startup. I mean, bootstrapping is the first stage. When you start as a founder, you pretty much put a bit of money that you have to get your concept out there. I think you get a lot of help from family and friends because it's easy to raise. There's low compliance cost, low cost of raising capital, and it's kind of preferred by investors. Look, I'm a serial investor and I invest in a lot of startups. I don't, when I look at a startup, I do not understand, why would I back a startup that's not put in any money themselves? So if you're so serious about what you do, then you first got to put yourself in line before you expect the investor to take risk with you. So I think this is a very, very popular method when you're just starting off, very early days. Bootstrap your venture yourself, and then you can access aspects of angel. When you're looking at launching the product in the market and expanding that, I think you look at aspects of angel investment, which is basically, it could be individual investors, it could be a group of individuals that like investing in. Typically, angel investment is accessed at an early stage in your venture. So you're still quite early in your journey. You would generally find angel investors with a high risk appetite because they are taking a punt or taking a gamble in you when you've really not proven your success. So obviously, if anybody wants to take that kind of high risk, they would obviously expect high returns. Then you've got options that are very popular today and new options like crowdfunding, where you can open up your venture to retail investors or individuals out there walking the street that want to put in some money through these platforms. This is actually a great avenue to not only raise capital but also test your product and service, because those individual customers or consumers that are putting in money through the crowd platform could also be a market validation tool for your product and service to get you the right feedback. Of course, crowdfunding, as it's open to everybody, is a very, very competitive space. And unless you've got an extremely unique product and service with a very well laid out strategy, it can become a bit challenging raising money like that. And it definitely attracts a lot of venture capitalists, because once you kind of go down the crowdfunding stage, it'll give you enough capital to be able to build your minimum viable product and launch it in the market, so that for the next rounds with venture capital, it kind of builds a base. Let's put it this way. Then we obviously have the venture capitalists. Now, there are all sorts of venture capital. Some come in the early stages, some come in the mid stages or the late stage of companies' growth. So these venture capitalists are basically professional funds that look at high potentially growth ventures or stable ventures, depending on which ventures they want to invest in. And generally they invest for equity. So they take equity in a company and put in the money. What we understand, being a venture capitalist myself and running multiple funds globally, the play is between 4 and 5 years. Some venture capitalists obviously stick for longer in a venture, but generally, when you look at the average out there in the market, what we realize is people are invested in ventures between 4 and 5 years, after which either they exit the venture by doing a divestiture to a corporate, or if the venture is really, really promising, one could also look at listing it in the stock market and raising public money, which is quite popularly called IPO, which is initial public offering. Then you've got various other avenues today to kind of raise capital. You've got the quintessential incubator and accelerators. These are basically program-based institutions that run with government grants or private grants. What they really do is build groups of ventures that they really like, with a very early stage focus and nurture them, mentor them, train them, help them in their go-to-market strategy, help them to develop their minimum viable product, and put in a little bit of money early in the day. So typically how incubators really work, if they fund you, is they obviously take a bit of equity in your business, and give you the initial seed capital to be able to prove your product in the market. Now, these incubators today are very, very popular. You could find them in various locations, all the major cities in the world, and it's quite a talked about subject today. In fact, I personally like incubators because they've got a great process and a step-by-step approach to take a startup venture to the market. And I think for any startup entrepreneur, it's a very valuable process to learn. Then you've obviously got competitions. Both corporates, governments, universities, institutions run these competitions, startup pitch competitions, where you participate, and there's a prize money that you could use to fuel your venture. Again, these competitions, and by and large, what I realize across the world, are early stage focused. These are very business pitch based. Obviously, since it's open to everybody, it's very competitive. And what these competitions are really trying to see is the strength of your business plan and business model, and more strength in your operating excellence to be able to take your venture and execute it extremely well out there in the market. Then you've got the quintessential grants. So both from the state level, the central level, and the federal government level, you've got a lot of grants available, specifically focused on innovation and entrepreneurship. The idea being these grants are to kind of bootstrap small, medium establishments, but what you kind of look at, because again, these grants are open to everybody, you tend to have these grants in predefined sectors that are important for the country's growth or the economy's growth, that the government, both the state, central, and the federal government have identified as the growth sectors. So you got to first fall into that category to be eligible for a grant. And there's a lot of focus on the eligibility criteria to access that grant. So it can't be accessed by everybody and every kind of business, where they're trying to obviously look at the technicality of your business plan, that whether it meets the step-by-step criteria that the government has identified. So that's an avenue, a real avenue for people, that have ventures in that eligible areas. Then, of course, the last aspect is loans. You could either go to a banking loan, or you could go and get microfinance from a non-banking financial corporation. The thing with loans that I personally find is, the focus of these institutions, both the banks and the NBFCs, are more on working capital. So if you've got a venture that's already generating a bit of revenue and you've got pressure on working capital, I think a lot of these loans are given to you at a lower interest rate for fueling and funding working capital requirements to grow your business. And everything that you need to prepare to be able to get a loan has to be backed up by your business revenues and your business plan, because the bank has to understand, whether you have the capability to service this loan and pay your installments in time. Is the business generating enough revenue to be able to do that? So that's kind of a landscape of different avenues that you can access to get capital for your ventures at different stage of your company's life cycle. The next is, let's kind of look at this a little more in detail. Let's look at the different stages that your venture would actually go through and the kind of capital that you would require. Now, just to give information, all the information displayed on the side is merely a basic landscape. It varies from country to country, it varies from continent to continent, and it varies from sector to sector. So you can't really generalize it. So, typically, when you start a venture, you're on the pre-seed funding stage, where you are trying to build a minimum viable product and test its feasibility in the market and build a launch plan. Typically, in this stage, you will looking at bootstrapping the venture yourself with your savings or whatever little money that you have, and support from your friends and family. What we realize when we look at hundreds of ventures across the world in this stage is valuations tend to kind of fall between $250,000 to $500,000 based on their business model. And of course, like I said before, this is very subjective. That can change from country to country, region to region, sector to sector. This is just to give you an idea. And generally, the kind of funding that you can hope to pull from yourself and friends and family in this stage is up to a maximum of about $100,000. Then you come to the next stage. If you've crossed the pre-seed funding stage and built your product, then you are looking at launching the product where you really need seed capital. For product launch, it's got to have a revenue focus. You're recruiting a basic team that will help you take the product to the market. You typically find investors like angel investors in this round. Crowdfunding is a very popular, avenue for people getting money for their seed round. And of course, very, very early stage VCs. A guy like me is typically going to fall into this seed funding area. Valuations generally, on an average, we see between 1 to 3 million, and you're looking at upwards of $500,000 in terms of funding, up to a maximum of $2 million. Then comes Series A, where things get a bit serious. Once you've crossed the seed funding stage and your venture is still quite successful, this is where you're talking about serious money. And that's the growth stage, when you're trying to implement your business model way beyond your own geography. Maybe you're looking at a national scale or multiple states in your country. You have a very scaling up focus. You want to scale the business. You want to take the business high, and you want to enhance your product offerings. So typically, when you kind of look at this round, you're looking at accelerators coming in that, as the name suggests, give you capital to accelerate your business. You're looking at serious level of venture capitalists coming in. Generally, we find in this, valuations could range between $5 million US dollars to $10 million US dollars. And, kind of the funding that we see people get in Series A is anywhere between 3 to 6 million. Again, I repeat myself, these are not generic. This is quite kind of common, and it vary from country to country, sector to sector. Then you're looking at Series B, when things get really, really serious. You're looking at big capital, serious capital. Your product beyond the Series A have already proved its worth. It's proven its market. It's proven to customers. And now you are enhancing the customer acquisition stage, and you need very, very serious capital to be able to do that. Your market is much bigger, the market size, so you need more capital to reach the kind of customers that you need to do. So customer acquisition, scaling up rapidly, and grabbing more market share by beating your competition seems to be focused in a Series B. The typical investors you look at are late stage venture capitalists who've got very, very deep pockets. The kind of valuation you could expect in a round like that is between 20 to 40 million. And the kind of funding that one could expect if you reach a Series B is 10 to 25 million. For that Series B, and then you come to Series C and onwards. Now, once you've crossed Series B, to me, in my opinion, you're already successful. You've proven your product or service in the market. Your customers love you. You're in multiple geographies selling your product. You are bettering your product by putting innovation in it. You basically ticked all the boxes. And now you're going for something called exponential growth, where you know that I need to buy companies or buy technology to be able to accelerate my venture and my business presence in new markets. So the focus is much on mergers and acquisitions, and the focus is much on opening new markets and geographies for your product and service, and kind of laying the groundwork to then go for an initial public offering by listing your venture in the stock market out there. So typically the investors you would find in this stage are late stage VCs, private equity funds, hedge funds, and investment bankers. Valuations could range from 50 million to 100 million US dollars. And the approximate funding that you could expect if you reach a Series C, it could be anywhere from 40 million to 60 million. And the final journey with your venture is obviously an initial public offering that I've talked about. After the Series C, you're rarely onto the IPO market, where the idea is to do further mergers and acquisitions. The idea is to grab more and more market share. The idea is to govern the business well. So you're looking at a professional board. You're looking at regulations and compliances, because you've got to become a listed company, a large company that listed on the stock markets with the regulators watching you quite closely. So the idea is to diversify and have enough capital to be able to do that. So the investors are public. Once you list your venture in the stock market, it's open for everybody to invest. Valuations could range broadly from $500 million upwards to about 2 billion. Can also go to 10 or 20 billion, depending on the sector that you are. And approximately funding that you could expect by the time you get to an IPO could anywhere be upwards of 100 million to 500 million. In a lot of cases, even $1 billion. But this is just, like I said, a generic framework to give you an idea. Lastly, what do I do? Like, my colleague introduced me. I'm a venture capitalist and a management consultant. So I essentially run two companies. I run Grover and Company, which is a management consulting practice. I've been running it for 15 years. We do a lot of market research, both primary and secondary. We do strategy development, business modeling, financial modeling, execution support. The strategies we develop, we help companies execute that and advise them how to do that. And we've got a global presence in New Zealand, Australia, Singapore, the United Arab Emirates, and the United Kingdom. So we've got the European Union, the Asia Pac, and the Middle East quite sorted out with our teams. So that's the business that I, am a part of, and I've been running for 15 years. In addition to that, I'm also a venture capitalist. I run Grover and Company Impact Ventures. So I've got two funds, one in Singapore and one in Dubai. The Singapore fund deals with deep technology, artificial intelligence, blockchain, machine learning. So we invest in early stage companies into fintech, education technology, health technology, and climate technology. My fund in Dubai is purely focused on food technology, trying to find meat replacement and dairy replacement, much talked about alternative proteins and alternative dairy on an early stage. We are early stage VCs, so we typically deal with seed capital between $100,000 and $500,000 per venture. And we are very, very committed across all our ventures on the United Nations Sustainable Development Goals framework. We are impact investors. We consider ESG very, very seriously. And, in all our ventures, ESG has to be a core strategy to be able to deliver growth. If ESG is not at the core of a venture strategy or a venture's growth, we do not even entertain or touch a venture like that. So that gives you a certain amount of understanding what we do. So we invest and we use our consulting teams across the world to be able to take our investment and make sense with it. So let me give you an example. If I'm investing in a alternative proteins company that makes plant-based chicken, to be able to build a strategy, look at the market research in terms of consumer-centric approach, look at what strategy works in which country, and then look at a business plan that is built on a very stable financial model. And then we use our teams across the world to execute that business plan. So our consulting team is a huge value addition to our investing arm that takes a company through the journey of building their plan, developing their strategy, executing their strategy in multiple international markets. That's what we do. So that's a bit about how you raise funding, why you need funding, what are the different sources available to you, and what are the life cycle of your company and what kind of funding you might need at different life cycle, and what I do as an individual, with my consulting arm and my investment arm. So thank you so much. I would love to take any questions anybody has.
Right there. I think we have a question from Shamsteen Lawal. Most banks require collateral before helping startup with loans. How can startups mitigate this challenge?
Yes, it's absolutely correct. Most banks do require collateral. Sometimes entrepreneurs could have property or have assets that they can take and use against funding for their businesses. But this is not something that I suggest or recommend to most entrepreneurs. You've got incubators available, accelerators available, crowdfunding platforms available, angel investors available. You've got so many avenues available that you really don't need to go to a bank and get a loan. People who go to a bank and get a loan to fund their ventures are typically the people who don't want to share any stake or any ownership of their company with anybody. So if I'm a guy who's got let's say hundreds of thousands of dollars of assets, and I don't have any dearth of money, I would not typically like to share my company with somebody because I know I have the capital to be able to do justice, at least in the first few years of the business. So this is not a very desired outcome to go to a bank and ask for a loan. You have far many other avenues available that you can do it.
Thank you so much. I believe, Shams, that answers your question. The next one is from Paresh Nandania. He says, hello. If any startup fails, then what happened with funding?
So, I think the answer lies in the question himself. So if a startup fails, the business comes to an end, and any investor who has already invested loses all the money. And obviously, as an entrepreneur, you lose a bit of reputation, because if you've lost anybody's money, they're not kind of very happy about it. So the likelihood of getting that investor again in any other new venture is quite unlikely. So I think his answer lies in the question that he's asked. If your startup fails, then everything comes to an end. Go back to your drawing board back again and reinvent another thing.
Thank you so much for that answer. Any more questions concerning the funding options for startups? Any more questions for Mr. Amit Grover? Please, this is a very great platform to ask any questions you have concerning startups, and that is why TechGenez brought this Startups Expo 2022, and the speakers are very learned in their area of expertise. So this is a very great platform to actually ask questions. And for him speaking on funding options for startups, I believe is a great opportunity to ask so many questions about funding. I believe a lot of startups have issues with funding and trying to get funding for their startups. So this is a very great opportunity to ask your questions.
Also, Sandra, I'll just like to put it out there. If any ventures are tuned in and following this podcast, please reach out to me on LinkedIn. LinkedIn is the easiest way to reach me. Grover and Company, or Amit Grover, or Grover Impact Ventures, however you want to kind of search me, and I'm very accessible. Happy to look at new ventures that fall under my thesis areas, and happy to fund them if it makes sense.
Perfect. Maybe just for those who are not able to hear what your criteria or like your area of expertise is in terms of funding, can you just tell which part you like to invest into?
Sure. So like I said in my presentation, I run two funds. So my first fund, that is based in Singapore, is all about deep technology. So we look at projects like fintech, edtech, which is education technology, health technology, and climate technology. It's very, very important and essential for those technologies to be backed up by artificial intelligence, machine learning, or blockchain. We could invest anywhere from $100,000 right up to $500,000 in that venture. You can see the slides. My second fund, which is in Dubai, which deals with food technology as a space. So in the food tech space, we look at alternative proteins and alternative dairy that are trying to find meat replacement and dairy replacement as products and technologies. And the same kind of aspect applies to them. We look at early stage investments from $100,000 to $500,000.
Thank you so much. So I believe we all had, in terms of his companies, the one in Singapore is really looking at technology, fintech, educational technology, climate technology, and they're willing to fund $100,000 to $500,000. And the one in Dubai is really looking at food in terms of alternative protein and dairy. So I believe Mr. Amit here has really given us a platform for any startup looking for investment in these two criteria. So which is very good. And he's already said that if you want to get in touch, kindly get in touch with him on LinkedIn. And that is the best platform for him. I think Karen was also here in case anybody else have questions for Karen Miller. Okay, so someone has a question again. I want to ask one question, Amit. What advice he gives his 21-year-old version if he's to come back to 21?
I would start becoming an entrepreneur much faster than I actually did. I actually turned into an entrepreneur at 32, and I potentially wasted 10 years doing that. I think the earlier that you can jump into this beautiful and amazing journey, the more you're going to learn, the more tenacity and the more strength you have to be able to build your venture, the more risk appetite you have to fail more and more, and keep succeeding. And let me tell you, for all my young friends tuning in, I have failed more times than I've succeeded in life. So failure is not a taboo. In fact, it is the vital ingredient that is ultimately going to take you to success, because each time you fail is each time you learn how not to do that wrongly. So embrace failure, learn from it, and don't get demotivated. I've failed 1,000 times and probably only succeeded 2 or 3. So that's the tenacity you need as an entrepreneur to be able to keep failing and keep moving forward.
Thank you so much. I think Paris, you did hear him. Maybe a take home is failure is a vital ingredient to take you to the next success, and that is something very important. Amit has just said. Are there any incubators or accelerators you can recommend for startups in Africa?
Look, I don't deal with the African market directly, but I deal with the Middle East. And I do believe that incubators and accelerators in the Middle East, look at Africa, West Africa, South Africa, and East Africa. I think, if someone was to reach out to me on LinkedIn, I could definitely suggest a list of accelerators that they can approach if their ventures in Africa. Africa is a huge focus area for the Middle East. In fact, just to give you statistics, the royal family of Middle East has just launched a $6 billion fund for African ventures. So there's plenty of money to access.
That's fantastic. There's also the Founders Institute. So the Founders Institute is a global organisation which I'm part of here in Australia, and they have accelerators and incubators in Africa.
Perfect. Thank you so much, Karim. I think we've all heard about that. Karim, I just shared one in Australia. So, Karim, do you want them to send you a message on LinkedIn also? Is that
Please,
the best
please feel free.
platform
Yeah,
for you?
that's the best way.
In case
That's the
anyone
best
has a
way to reach.
question.
Absolutely. Go for it.
Okay. I think Carla Maria has a question. Could you recommend an incubator in Mexico?
No idea. I don't deal with the Latin American market.
Okay. Okay. I think that answers your question, Carla. Any more questions? Karen Miller was talking on marketing and researching as a startup. Amit is also looking at the funding options for startups. So I believe these two right on here are the perfect speakers to be also able to ask our questions on funding and researching. Basically, these two work hand in hand. So any more questions for Karen and Amit? After the last question, we'll be going for a section break for 5 minutes and we will be back. I believe all the things we've actually heard is good for us to go sit down, take our book in hand, and really look at what we've actually pinned down to recall. For Karen and all the speakers that have already come, they've really shared a lot of things that I believe has opened our eyes to our startups exposition. And I believe TechGenez will also provide the PowerPoint presentations they use maybe for a few days on their platform, maybe after this program, to make it easier to access it on the startupsexpo.com on Google. So that could be something we'll also work with. Yeah. Any more questions? If not, we'll just be going for a sessional break for 5 minutes and we will be back with a great speakers to give us more insight into startup exposition. Any more questions?
I just wanted to mention to Carla Maria that there is a Founder Institute in Mexico. So she can reach out to Founder Institute in Mexico. So that's on fi.co.
Okay.
And she can just Google it easy to find. They have incubators. It works about 13-week program, and you'll have mentors from all over the world available to help her through her process.
Okay. Thank you so much, Karen. I believe, Carla, you heard about that. So it's a very easy way, as Karen has already said. Any more questions, please? If not, we'll be going for a short sessional break and we'll be back after 5 minutes. Thank you so much for being on here to the Startup Exposition. We will be looking forward to seeing you in 5 minutes' time. Thank you.